Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, welcoming you back for another week of making sense of money and the markets so that you can make better informed decisions about building your wealth. We're not quite 2 months through the year yet, and still 2022 is proving to be one of the most uncertain and challenging years for investors since the global financial crisis ended in 2009. Inflation is running at a 40-year high, while supply chain disruptions stubbornly persist. And this has forced the Fed to reverse course, and it's now pursuing a policy of interest rate hikes that threaten to burst the price bubble in financial assets and potentially send our slowing economy into recession. Geopolitical risks, as evidenced by the unfolding developments in the Ukraine, have suddenly roared back to the forefront after years of relative tranquility among nations. When trying to understand where a complex environment like this is headed, they say two heads are better than one. But things are so complicated today that I think we need to double that to four heads. We are extremely fortunate today to be joined by four of the most accomplished macro analysts in the world of online finance. In today's video, I'll be moderating a roundtable including Danielle DiMartino Booth, CEO and Chief Strategist of Quill Intelligence, Lynn Alden, publisher of LynnAlden.com, Ivy Zelman, founder of housing research firm Zelman Associates, and last but certainly not least, Stephany Pomboy, founder of MacroMavens.com. This is a powerhouse of talent, folks, and it required no small amount of sacrifice on each of their parts to make themselves all available at the same time for this roundtable discussion. So if you will, please take a moment here at the start to hit the like button as a show of gratitude to these fine experts for coming on this channel. All right, with that done, we have a lot of ground to cover in limited time with this brain trust. So let's dive right in.
Thanks for having us.
All right, as I think I told you guys before we started recording here, I've been mentioning to the Wealthion audience that we were going to do this roundtable with you guys, and they are just ferociously interested in this. So they're super excited. So thank you again so much for all coming together here. So, my job here is just to keep the questions flowing, but I'd love for this to be as interactive as possible. So if you have a reaction to anything that your colleagues say, literally just chime right in. Want to keep this thing as fluid as possible. All right, I'm going to start. I've got a lot of questions here, but I want to start at a very high level with a question that I generally tend to ask all of my guests at the beginning of these videos. And I'm going to ask it of each one of you here. And just in the interest of time, maybe just, if somebody said something you've agreed with, you don't have to repeat that. You can just add any additional color that you'd like here. But the question is, what is your current assessment of today's global economy and financial markets? And Lynn, why don't we start off with you?
So I think the way to summarize it is that, the U.S. economy is decelerating. So purchasing manager indices and other leading indicators are rolling over at a time when the Fed is trying to tighten to control inflation. And so that's somewhat of a stagflationary environment, and that's challenging for most risk assets ranging from equities to bonds. It's probably somewhat favorable for gold. We're seeing somewhat different dynamics in emerging markets where a lot of them had pain in last year, where they were already tightening heavily into the inflation, or in other cases they were cracking down on their industries, and some of them have kind of rising credit cycles, it seems. And so I think that the capital flows and the attractiveness in some assets has shifted from some of the winners of the past 2 years to some of the losers of the past 2 years.
All right, great. All right, so the winners are becoming losers and perhaps vice versa. Danielle, why don't we come to you next?
So to Lynn's point, we are seeing stagflation spread across the globe. That's something that was evident in the recent UK, Euro area, and Japanese PMIs. We're seeing inventories build. We're seeing delivery times start to finally roll over. And the implication is that we're going to see output prices themselves start to come down. So again, it looks like we've hit peak inflation, at least in the cyclical sectors, and the cyclical sectors do tend to drive the train. If you look at the world's third largest exporting nation, Germany, Their Bundesbank has announced that they are likely in recession for a second consecutive quarter in the first quarter. So that is something that is notable. And I would put out there that the China factor is not what it was the last time we were in industrial recession, which was 2015, 2016. And China was able to deploy sufficient resources globally to pick up the rest of the world out of this industrial recession. That won't be the case in 2022. Xi Jinping is solely focused on making sure that people who have already taken out mortgages and been promised homes actually get delivery of those homes. He's not as near as focused on building new high rises, on supporting the Chilean copper market. So the ripple effect is going to be inside of China in 2022 so that he in November can get that third unprecedented term as president. And I think that's where his focuses are going to be. And that will make it that much more difficult for the US industrial sector and other countries along the supply chain who are counting on China to come to the rescue. And that's not going to happen. So my eyes are focused on two things right now. That's the yield curve and the credit curve. We can get to that in a little bit. But I think if you're, I'll hold off for Ivy, but the Lacey Hunt School of Thought dictates that you follow autos and housing. They're the two sectors that lead economies in and out of recession. And we're definitely seeing cracks in those two markets.
All right, fascinating. A lot of threads there I want to pull on, everything from stagflation to peak inflation, slowing economic growth, maybe tipping into recession, and the fact that China might not be able to bail us out this time like they did last time. But you gave a great segue there to Ivy. So Ivy, let's head to you next. Danielle just mentioned keep our eyes on here in terms of where the global economy is going is what's happening in autos and housing. You are a specialist in housing. What would you like to add to this?
Well, first, just thank you for having me. I think the reality, Adam, is that the housing market is still red hot. And despite, rates surging, what we've seen is that investors are really the driving force of growth. And if you look at 2000, at least within the US, I think real estate's, recognizing as an asset class is viewed to be a safe haven against inflation. And so what we've had is many investors selling equities, private investors to buy residential real estate. The same thing with institutional capital within the commercial real estate world, which there's not as many attractive assets. So a lot of that capital has been deployed to the residential sector. And that's really putting pressure on inventories that are at all-time record lows. So while we don't have growth per se, right now we're seeing declines in overall metrics related to housing. It's not demand related. And home prices continue to surge because of the tight conditions of the market. And I don't know what's going to change the investor appetite, but I'll just tell you that in 2021, existing home sales grew 9%. The entire 9% growth is explained by the incremental growth is explained by investors. The primary buyer is being, at least on the entry level price point, is really being driven out of the market. They can't compete from a cash perspective with these institutional investors, private investors. So it's an interesting dynamic because a lot of people that are not as focused as we are in terms of boots on the ground, in the weeds in the trees, they're looking at just the absolute year over year numbers and assuming that means housing's weakening. I think you can argue no growth is bad, but it's not reflective in any other metric reflected in terms of inflation and home prices, if that makes sense.
Okay, yeah, it does. And I do want to dig more deeply into housing in just a little bit. But it sounds like you're saying right now, capital is still flowing into the housing market, but largely flowing from the investor side of things. And, keeping our eye on that, but you're not seeing it cooling off.
The only other area that's, I guess, luxury is very strong right now. And that doesn't have the same level of investors with the exception of second home buyers, which has really been a big driving force in luxury. We talk luxury above $1 million in the US.
Okay, great. When we get into housing, I want to talk about whether COVID's been a factor in that too, of just driving people to get, an extra house somewhere if they've got the means to do so. But let's save that for when we really dive into housing here. All right, Stephany, coming to you to bat cleanup here. Anything to add beyond what the other women have said here so far?
My general outlook has been that the entire recovery that we saw was built on stimulus. And to the extent that that stimulus is now reversing both fiscal and monetary, I expect the speed of the slowdown, which everyone anticipates, will be substantially faster and more dramatic than the consensus sees. And that obviously sets up a lot of risk and opportunity in the markets as relates to credit spreads, which Danielle alluded to, and I'm sure we'll get into later. And obviously, safe havens like gold and treasuries, et cetera. But so my general outlook is that the economy is going to surprise in terms of how quickly and sharply it slows. And then further to a point that I think it was Danielle that mentioned about the pressure on output prices relative to input prices. That's something I've been tracking for a while because it foreshadows a profits recession. We have never seen the CPI lag this far behind the PPI in history, except for 1974. And obviously that wasn't a very good time for stocks. And anytime we've been close to this, you've had a profits recession. That is nowhere on anyone's radar right now. The S&P consensus forecast for earnings is around 8% for this year, with 42% growth in consumer discretionary, which I think is another area we could talk about ripe for tremendous disappointment. Broadening the lens to sort of global factors that I'd be focused on, I also echo Danielle on China. And you and I talked at length about this, Adam, in our recent conversation, that I think the surprise will be that China will abide the deflation of its credit bubble. That is, after all, exactly why it pursued these measures. It is trying to deflate the bubble, and the hysteria in the West that, when things get really bad, they're going to come in with the fire hoses is really a reflection of our own sort of ingrained response, because we've learned since 1986 that that's what our Federal Reserve does. That doesn't mean that that's what China's going to do. And they have a lot of ability to control that, to manage the deflation of that bubble in terms of, helping the homeowners that would otherwise be left without the residences they were due, et cetera. But I think, again, China is not going to rush to bail out the property developers or the people who lent to them. So I think that could be a surprise to the markets. Again, I think there's too much complacency on that score. But so much to talk about. We haven't even mentioned oil yet, and that's obviously another potential fly in the ointment and another tax on growth both here and abroad. So I'll kick it back over to you, Adam, to see what you want to take from there.
All right, we will get to oil in just a bit. So, sort of seems a universal theme through your guys' views, perhaps with the exception of Ivy not seeing this in housing yet. But economic growth looks like it's going to be stagnating, or maybe that's too serious a word, but slowing down going forward. And we're not going to be able to have a white knight ride to the rescue the way that China has in the past at times when the global economy has slowed. And it looks like in the US here, we're not going to have the stimulus that we've been so accustomed to having, in the past, certainly in the past 10 years. From the Federal Reserve, and now Congress seems to have much harder trouble getting fiscal stimulus passed as well. So it's sort of to Stephany's point there, stimulus flows may be kind of the dominant theme of 2022, and specifically the reduction in stimulus flows. So let's talk about the Fed just for a second. So Danielle, I'll start with you because you were a former advisor to the Fed itself. The Fed has turned hawkish policy-wise and should finish their accelerated taper next month, and then relatively quickly start hiking interest rates if their talk is to be believed. How aggressive do you think they're going to be able to be, or successful they're going to be able to be, based upon the current plan that they're communicating? Do you think they're going to be able to successfully do 3 rate hikes this week, maybe this year, maybe a few next year, or could the weakness in the markets and the weakness in the economy basically force them to have to pivot at some point?
So there is no such thing as ceteris paribus at the Fed, but there is this thing called inflation, and it being a midterm election year. These are two factors that have not had to enter the discussion since Paul Volcker was in the Eccles building. I don't think that investors, because most investors who are alive today weren't at least investors back in the late 70s. So they don't remember how much more difficult decisions are. And we have to bear in mind, the Fed has not committed one, but two policy errors. They bailed out the corporate bond market on March the 23rd, 2020, including grandfathering in BBB, the lowest credit rate it rung before junk. So that was the first major policy error, because that ended up creating a bunch of dead weight that, to Stephany's point, is going to expedite the deceleration of the US economy in the current compression that I call compressed. It's a cycle compression. The second policy error came about when they didn't step back from the mortgage-backed securities market. After Federal Reserve Governor Christopher Waller came into office and said, housing is white hot, the Fed has absolutely no business being in the housing market anymore. The fact that we are is emblematic of the Fed doing credit easing, which is against its mandate. And in fact, they mentioned that in the most recent statement that was released, that they're going to get out of the business of credit easing. That flags the fact that they're actually willing to step into a third policy error knowingly. So you've gone from 3/31 of 21, March 31st, 21, you've gone from 160 basis points to 40 basis points on the 2s, 10s. That typically pre-Greenspan would have said that the Fed had 40 basis points of tightening in the chamber. And that's inclusive of balance sheet reduction. But the implication is that they're one and done on March the 16th. That ain't going to happen. I think that Jay Powell is paying much more close attention to another 2s, 10s curves, that of the BBBs. I think he's focused on how much leeway the credit market is going to give him before it breaks. And if I'm wrong, I'm wrong, but I think that he's determined to do more tightening than what's expected because of the immense political pressure against this inflationary backdrop that is the most regressive of taxes. So if you look at the compression of the 2s, 10s, and the BBBs, we've gone from 225 basis points to 75 basis points. Hasn't compressed as much, but the implication is that there are 3 Fed rate hikes in the chamber instead of the 1, and that Powell may knowingly put the US economy into recession, which Paul Volcker did, in order to contend with the fact that because of previous fiscal policy errors, added to monetizing every last cent of the stimulus that went directly to the people and convert it directly into inflation. All of this is going to add up to Powell either having the cojones or not to knowingly put the US economy into recession, because once the 2s, 10s yield curve is flat or approaching inversion, Wall Street's going to start going, oh my God, it's the 2s, 10s. What if Powell's looking past that? And knowing that the US economy is going into recession, period. And we've round tripped with vacation plans viewed through the Conference Board and consumer sentiment data. So now you've got, going into spring break 2022, you've got American families pulling back aggressively in terms of their plans to take a vacation. That's telling you that the goods baton to the services baton, that narrative of this is what's going to support 71% of US GDP, that is consumption, that services narrative is falling flat, and that Americans aren't going to be able to splurge outside of the 20% of top quintile earners who are responsible for 40% plus of consumption. We'll see how they feel about consuming if the stock market continues to misbehave. But I think that the Fed may knowingly commit the third policy error and go further down the tightening path than what's anticipated by the yield curve right now.
All right. So basically we have Jay Powell growing a backbone, the guy who's been slammed for the Powell pivot back in at the end of 2018. Now he's actually deciding to, actually deliver the tough medicine the market, the system needs here. All right, so Lynn, let me come to you for this. So you said, you were seeing sort of stagflation going forward. Curious any feedback you have on Danielle's thoughts there. But if that does happen, and we have Powell tightening more aggressively or hiking rates more aggressively than the market currently expects, going into a stagflationary environment, what does that really mean? What are the repercussions of that? That seems like, as Danielle said, it might very easily tip the economy into recession and could result in a lot of pain for the average American household.
Yeah, part of why asset prices performed so poorly across the board in the 1970s was because you had that inflationary environment which pressured margins and made long-term planning difficult, but then you also had higher rates that put downward pressure on valuations of risk assets compared to those risk-free rates. And given the current position of where the Fed is, right? So with inflation as high as it is, and with the labor market as tight as it is, their clear mandate is to try to tighten at least until something breaks. And so the big question is, where does it break and what breaks? So do credit markets break like they broke in 2018? Does the treasury market go liquid like it did back in say early 2020? There's things to watch out for what might break eventually and where it breaks. But I think that their clear mandate is to try to tighten until they get something like that, and then they can kind of say, look, it's out of our hands. We have to do what we have to do, because kind of that shadow mandate of financial stability sort of steps in at that point. I think the key thing to look at and be cognizant of is how high debt is relative to GDP compared to the 1970s. So when we go back to the 70s, you had household debt at something like 45% of GDP. Now it's up to like 80%. It's down from the subprime crisis, but it's far higher than it was in the 70s. If you look at federal debt, back then it was under 40% of GDP. Now it's over 120% of GDP. And so the challenge is that going to those positive real rate levels in this environment is a lot harder than the 70s. And so that's one of the reasons I actually go back further to the 1940s to see that the prior inflationary decade, where you had wartime finance, which is in some ways similar to what we had over the past couple of years. It's kind of high debt, wartime finance. The only other time federal debt to GDP was as high as it is now is that you had a rather weak response. You had basically the Fed captured by the Treasury. It's obviously a very different environment back then, a lot of different aspects to consider, but you had basically them holding rates relatively low compared to inflation. And so far, what caught a lot of people off guard was, if you asked people a couple of years ago, if inflation's over 7%, what will the Fed funds rates be, and what will they be doing, quantitative easing or tightening? Not many people would say that they'd still be at zero and doing quantitative easing and talking about raising rates and tightening. So they've been kind of deliberately behind the curve. But now that their mandates have caught up to them and kind of pushed them, they clearly have to tighten. And I think, I'm going to somewhat take the under on the Fed's ability to tighten until something breaks. So I think they are going to tighten, and they are going to, do their best to follow their mandates. But I think that there's a lot of caution to be warranted about how far they're going to be able to get with that tightening, given that the economy is rolling over and given how much debt is in the system relative to the 70s, which we, it's our kind of our most recent thing to compare things to, but there's still so many differences there.
But Lynn,
All
let
right.
me
Yeah.
ask you a question, Lynn, just to jump in. Sorry, I'm supposed to raise my hand. Let's assume that the Fed can't tighten, or they're in a position where they have to pull back on that strategy. Then what happens?
Well, then you get basically a currency devaluation. And this is not a US only phenomenon, right? So Europe has this issue where they're trying to manage spreads between different countries, right? So Italy, for example, has like 150% debt to GDP, and they're kind of only solvent to the extent that the ECB helps them be solvent, right? So they wouldn't do well on their own when selling bonds to the private market. And then you have Japan at over 250% debt to GDP. So it becomes some of a race to the bottom that emerging markets, because of the way that they're structured, they generally have lower debt to GDP. But the problem is that more of the debt is denominated in currencies they can't control, mainly the dollar and the euro. But they're able to tighten into inflation because they have to, and because they have lower debt. So you saw Brazil, for example, go from 2% interest rates to 9% interest rates last year to try to combat inflation because they had to. Whereas developed markets, because they have more stable currencies, but they also have this longer period of low rates, they build up so much debt that they're actually it's challenging for them to raise rates. And so the ones that are unable to raise rates due to the debt, despite inflation, or at least unable to raise them enough to say positive real levels, they're prone to currency devaluation, in my view.
All right, Ivy, thank you for jumping in there. I love you guys popcorning off each other. So please, when the spirit strikes you guys, continue to do that. Let's stay with you just for a second, Ivy. And as I transition over to you, I just got to say, what's so hard for me here is I've got a zillion follow-up questions for each of you that I'm just biting my tongue, not asking. So we'll have time to get through some more of these questions. But you're all doing so wonderful so far. Thank you. So Ivy, if Indeed, the Fed goes on an aggressive rate hiking campaign from here. Is there a level at which you feel that, hey, that's kind of toxic to housing prices? Like that's the price that's the mortgage rate at which housing prices are really going to start to break?
Well, I guess assuming that the yield curve doesn't invert and that, the long end of the curve, whether the two versus the 10 continues to maintain the current spread. But for us, when one of the Fed policy, I guess backlashes, the decisions they've made, is that there's been this massive refi boom. So if rates were to go even as high as, call it 4.25%, people are disincentivized to move, with almost 70%, roughly 70% of homeowners have a rate below 4%. And so that to me is a cutoff that will start to matter to that, again, that primary buyer, that they'll be disincentivized to move. But I'm not, sure what the long end of the curve is going to do. With MBS prices under pressure, if the Fed is not in the market buying MBS, there's less supply, but as rates rise, there's less origination, less refi. So I don't know. I'd really turn back to Danielle and Lynn and Stephany to say, what is the long end going to do, even if they're tightening on the short end? I hear from a lot of smart people that the curve's going to invert, which could keep housing as one of the more, safer places to hide. I don't know, in this environment.
So I'm going to jump in for 2 seconds and tee it off to Stephany. And I would just say that, Stephany, based on the work that you've done on stimulus driving this entire train, to the extent that households were able to pull billions and billions of dollars out of their home equity in cash out refinancings, which did come back from the grave in the last 18 months or so, that kind of compounds your thesis based on stimulus not being there anymore.
100%. Thanks for that. That softball pitch down the middle there, Danielle. But one thing that is just
somebody's got to play baseball.
One thing that's been staggering to me is, they talked about how strong the recovery was and this incredible boom in consumer spending. But if you look at the increase in household net worth that we saw over the 2-year COVID stretch, it is mind-boggling. We saw more than $30 trillion increase in household net worth in 2 years. I mean, and when you chart that, you have to rescale it because you've never seen anything that high. GDP is 20 trillion, just to put it in context. So in 2 years, households had this 30 trillion increase, plus they got cash handed to them by the government. And yet their spending was only as good as those checks in the mailbox. I mean, you can watch from month to month, the months that checks arrived in the mailbox, spending and retail sales popped. The months they stopped, spending and retail sales slumped. And as soon as the stimulus completely stopped in terms of the CARES cashola, the literal helicopter money, we saw a 180 in terms of credit card borrowing after paying down balances at a record pace during COVID with all their COVID stimulus money. Borrowing has ramped higher, and that is not a sign of strength whatsoever. So all those things just kind of, as Danielle suggested, feed my sense that the economy will slow substantially faster than people expect, because the underlying strength of the economy and the strength of the consumer is not at all what the markets currently perceive. Which brings me back to this Federal Reserve discussion, if I can get my 2 cents in there, Adam, and that is, Lynn, you missed your opportunity on the low end, because I've been calling for 0 rate hikes throughout on the argument that we can barely handle the taper, given what I see as the fundamental weakness of the economy, excluding the stimulus. So just tapering, because it's reducing credit growth, and growth in credit is what's, it's the fuel in the tank of the US economy. And if I can use a really tired analogy, we're getting less and less miles per gallon on that fuel to begin with. So even if we grew credit by the same amount as we did last year, it's going to translate to less economic growth. So the idea that the Fed can reduce growth in credit without substantially reducing economic growth is one that I've obviously disputed, and that's before we talk about raising rates. Furthermore, you've seen tightening already. The Fed's done nothing, but obviously, and I'm not just talking about the Treasury market with 2-year yields backing up. I'm talking about the corporate bond market. We've seen a massive tightening already. And what's really interesting is even after the January rout in stocks, where we saw these kind of buy the dip frenzies where people would rush in and, S&P would be up a ton and the Dow would be up 600 points. The corporate credit market continued to deteriorate. That is a red flag if ever I saw one. This is exactly like 2007 when we started to see asset-backed commercial paper start to seize up. And the stock market was singing zippity doo dah, even as it was very clear that we were having real financial stress. And that, I'm told that, and you would be able to speak to this, Danielle, that Jay Powell is a credits guy and that he's really focused on credit. And I know that's what you were alluding to with the triple B curve. But the curve notwithstanding, the absolute level of the backup in rates we've seen so far, I would think would be tickling him a little bit to maybe want to backpedal, given the state of corporate balance sheets right now. For a company, even though interest rates are only up a little bit from very low levels, for a company that borrowed at those unprecedented low levels and sees they've got to roll paper, at 50 basis points higher, that may be make or break for them, especially with oil prices going up, et cetera, et cetera. So anyway, that I laid a lot out there, and I'm sure Danielle has plenty to say and the other ladies on this topic. So I'll throw it back to you, Adam, and you can decide what you want to do with it.
I'm tossing the potato to Danielle briefly. Go, Danielle.
So credit's a funny thing. I mean, Pat Toomey's sticking by his term limits, and he really is leaving, and he really did lay the law down with the last stimulus bill that Trump signed into law. Janet Yellen does not have the legal authority without congressional approval to put those credit facilities back into action, period, end. And that's why you've seen LQD outflows outpacing that of HYG, because all Powell did by grandfathering in triple Bs was ensure that the zombies would remain alive, but grow much more substantially. We've gone from 10 to $12 trillion just looking at the corporate bond market alone in a very compressed time chamber. I mean, issuance has gone batshit. Sorry, it's gone crazy. So we can edit that out. But we've never seen issuance of this magnitude in such a short time frame. And yet people are like, but look at all the equity that's been sold. The debt to equity ratios look so much better. And I'm like, got profits? So we're coming into a margin squeeze. Jay Powell understands duration. Jay Powell understands credit. Jay Powell is also the Fed chair who's been up to the hill more than any of his predecessors. He's in contact with everybody in Congress. He's also, by the way, not confirmed. Neither are 4 others who are sitting in the Senate in this bizarre holding pattern that I've never seen. And I think he might allow something to break as long as it's not credit. I think he might sacrifice a recession that he can already see coming. I don't know that even pulling back today on that first rate hike on March the 16th, which his 2 top lieutenants, John Williams and Lael Brainerd, have already said it's coming on March the 16th. So even if they get that first one off, I don't think that he necessarily stops until something in credit breaks. And it's taking such a massive risk because of what's happening with oil, because he didn't step back from housing, because the anecdotes won't go away. Adam, I just pay 20% more to renew my apartment lease. I mean, social media is toxic for Jay Powell, because as much as we would prefer to not hear about inflation, it's in your face, including and especially the 25% increase in food stamp benefits that was rolled out on October the 1st that made US food inflation even bigger than that of the rest of the world. And that was executive order signed in. So there are a lot of things right now that are completely out of Jay Powell's control when it comes to inflation that could force his hand, and people like Joe Manchin and Mitch McConnell, they're just sitting back on their heels and saying, let it break under Janet Yellen. Let's see what she can and can't do, because the plumbing of the financial system, the standing repo facility, the reverse repo facility, they're intact, they're in place and ready to be deployed so that the treasury market itself doesn't break. So if you can keep liquidity in the risk-free asset going, no matter what, come what may in Asian trading, he might allow for the U.S. economy to go into recession, knowing he has very little control over so many aspects and inputs of inflation.
But what happens? Can I jump in here, Adam? I should
Absolutely.
be raising my. What happens if that credit market seizing up leads to the stock market doing another? I mean, we're already down almost 10% on the S&P. We're in correction territory.
No, I'm watching the credit curve. I'm watching triple Bs. He saw the whites of the eyes of systemic risk in December of 2018. He knows that's a bigger beast than he is. And if systemic risk comes unleashed, God knows what's going to happen, because you've still got Japanese banks loaded up with this garbage. And the fact that you had leveraged loans weakening with the anticipation that the Fed was going to, I mean, there are certain things that are like big red flags.
Right.
So if credit breaks, he'll have no choice. He'll have to step back, because then systemic risk will come into play. And that's a whole different thing. Lynn's raising her hand.
I'll just jump in and echo that I think credit markets are the thing to watch primarily, because to the Fed's credit, they learned from what happened in March 2020 with the Treasury market. That's why they have repo facilities in place before they need them, right? So they are thinking ahead in terms of keeping that liquid before they need to resort to it in real time. And I don't think that they care too much in this environment, given inflation at 7.5%, what the stock market does. So when people look back at 2018, they think of the stock market going down 20%, but what the bigger deal under the surface was credit market freezing. And so I do think going forward that the number one, if there's one thing I had to watch every day, it'd be like, what is credit market doing? And so I think that Treasury market, that's obviously the most important thing. But I think that they already have things in place for that, and they don't really have a lot of tools to deal with the credit market. And so I do think that's the thing to watch primarily.
All right, I'll jump back in here, but I got to tell you, I'm just enjoying watching all you guys riff off each other. So please continue to do that. I guess there's so many things I want to react to, so little time. But we're talking about, okay, what happens if the system gets to a breaking point, right? And it looks like the big fear you guys have is around the credit markets breaking. Let's just go there for a minute, and sort of two questions. One is, like, when you lie awake at night worrying, how bad could it get if things truly reach a breaking point here? And what do you think that would look like? And then secondly, kind of to the point Danielle was talking about with the Joe Manchins of the world's leaning back, I think there are a lot of our viewers that are almost kind of rooting for this system to break, because they know it's unsustainable, and they kind of feel like we almost need to get to a breaking point where hopefully, once the dust settles, saner thinking will prevail, and people will say, well, gosh, maybe we should do things a little bit, more intelligently going forward. Do you guys almost think that a breaking point is needed? And Lynn, maybe I'll push it back to you first, and then we'll go from there.
I think that's ultimately where this train ends. We go through a very unpleasant period before we get to whatever's next. I think that if there's one thing that keeps you up at night over the long run, it's energy supply. And so I think a lot of things are workable as long as there's enough energy. But if you were to say, what would trigger the most catastrophic outcomes for the world economy, this decade, it would be acute energy shortages, right? So I think that's probably the number one risk on my radar longer term.
Right. And I'm sorry to interrupt. But could you also just address in your answer here the fact that a lot of commodity spaces, but certainly a lot of energy spaces, oil, et cetera, have been relatively starved of capital expenditures in previous years. And so, there's a lot of people that think that even if we have clear sailing going forward, we just may have some supply issues in our future because we haven't invested in enough development and exploration in the past decades. Do you have that worry too, even irrespective of other types of things that might constrain supply, like geopolitical tensions and things like that?
Yeah, I think outside of 6 to 12-month credit cycles and whatever's happening in Europe, things like that, I think that the longer term issue is lack of capex and some of the intentional energy policies. I think if I were to criticize the economics profession, a lot of the models are very demand side driven, and not a lot of economists will tell you at any given time what's happening in energy and copper and nickel capex, for example. I think more attention has to be on what's happening on the supply side. And one of the big differences in my view for the 2020s compared to the 2010s is that overall energy and commodity supply is tighter than it was back then. Before you had oversupply, and then you had China slow down. So you had this kind of structural oversupply. You also had U.S. shale oil come online and kind of just totally dislocate global energy markets. And I think that at least the growth of that is behind us. And so now I think we're in a more structurally tight environment. And that doesn't mean energy prices can't go down 30% over a 6-month period if you have, say, a recession or something like that. It's not a cyclical call. It's the fact that I think that this decade overall is tighter. And so if you get that out of hand, I think that's the biggest risk. Outside of that, I would watch credit markets. I would also watch just overall GDP, yield curve, and housing. Kind of basically the Fed can't print more supply. They can't print more oil. They can reduce the demand side. And so from the consumer perspective or the voting perspective, it's kind of like, do you want hot inflation or do you want a recession? And that's kind of the challenge if you're a politician in power or if you're at the Fed right now.
Adam, I've got a question that is talking about what Lynn is talking about to Ivy. And that is, Ivy's more than aware that there's $250 some odd billion of dry powder allocated towards real estate. And that is increasingly, as we're starting to watch office melt, that is increasingly being earmarked for residential, for better, for worse. But my question is, Ivy, if other parts of private equity, the traditional LBO space, we know that they're buying into a lot of these deals at ridiculous nosebleed multiples to get some of these done, to get some of these deals done, to keep credit open to the extent that it is. But if things start to go wrong in private equityville and investors need to have harvest returns where they are, talk about the backup, the backdrop, the demographic backdrop that could potentially underpin the housing market or not, compared to the NAR's, there's $6.8 million of million homes, unit homes deficit sitting out there.
Right, and we're quite contrarian on the demographic outlook and quite sobering in terms of our view that with a population that's been decelerating relative to any other prior decade at the slowest rate of growth, household growth is slowing as well. So what we would say is that the market is currently kind of more in balance. And as we look at the supply, the pipeline coming, which looks like a hockey stick, you look at the backlog of single family homes, multifamily homes, multifamily is at the multi-decade high. And there's just so much of that being targeted for suburbia. And then we have the new sexy, prettiest girl to dance, build for rent, where there's about 90 billion of earmarked capital, only about 20% of which has even been deployed. I think the question is, where are all the bodies going to come from? All the supply that's coming, how are they going to fill up these homes? And they're not building affordable housing. They're building, rental housing that's pretty expensive. And I think what will likely happen is that we'll have pricing pressure in the markets where the concentration is the greatest with respect to where they think it's most desirable. So ironically, everybody's perception is that the red states, or let's say the smile states, as we called it, the sand states, whatever you want to say, that's where all the capital's going. So it's no secret that Austin is got very, very strong job growth, but that's where all the builders and developers go. So I think you're going to see pressure on prices when the supply comes, but in the near term, it's a chicken and an egg because the supply is not coming because of backup, whether it's at the local municipality level, whether it's supply chain bottlenecks. I was just part of this function I attended last week where price increases across every building product input is being basically double-digit increases. And they're justifying it because their cost inputs are rising. So there's no slowing yet of that inflation that we're seeing real time. But at what intersection does the kind of homes that they thought they'd get leased up and the single family rental market, does it start to say investors I can't give you that return I promised you? And then you start to see the capital that hasn't been announced or hasn't been actually deployed, maybe start, running for the hills, so to speak, get a little bit nervous. So I'm not so sure how it will play out because there's not that much that's actually been, shovel in the ground, already developed, as much as it's supposedly what's coming. So we'll see, but there could be too many homes and not enough bodies if we allow that pipeline to get fully delivered.
Interesting. All right, so we've got supply tightening on lots of key commodities that Lynn just mentioned. We have disappointing demographics that are going to make supply of bodies that can afford, lots of things, but particularly higher priced houses diminishing as well going forward. We have a potentially oncoming increase in inventories and supply that you're just warning about there, Ivy. So we've got a lot of, what I would call not very, salubrious, trends colliding here with each other. Stephany, I want to go to you here for your worry list, and then I want to kind of try to wrap this into what does it mean for the actual regular person. So let's hear what keeps you up at night around all this, Stephany.
First off, kudos for salubrious, one of my favorite words, right up there with lugubrious. Oh my gosh. I think listening to this conversation, the one thing that I would, I guess, push back on is this idea that a correction in the stock market isn't something that would be worthy of the Fed reversing course or be, significant enough to really have meaning. I guess, or maybe I'm overstating the view, but my sense is that a correction in the stock market would be far more impactful on the economy. It's sort of the tail wagging the dog in some respects, from just the wealth effect, whether it's real or imagined. But also I have this kind of harebrained idea that a lot of the labor shortage may be a function of people who became day traders and made a ton of money trading their, whether it was Bitcoin or whatever meme stocks they were trading, who decided, I don't need to go back and work a 9 to 5 when I'm making all this money and it's so easy because the market only goes up every day. But even on a more serious note, I think the economic drag from a material correction in the stock market would come from the absolute devastation it would inflict on the pension system. And that feeds right back to state and local governments, who will have to immediately plug holes in those pensions, and will have to implement belt tightening, tax increases and spending cuts, which will be a real drag on the economy. So I do think that a meaningful correction in the stock market has very material economic consequences, beyond just hitting the high end. I actually think it'll be far more destructive to the middle class and the low end than most people think, just because they're invested in the market via their pensions, whether they know it or not. But I guess in terms of the things I worry about, that was the question, I think, before I started rambling on my tangent. Credit spreads, I will echo that same thing. I'm definitely focused on credit. I think the degree to which corporate balance sheets are really stretched is underestimated. If you look at the S&P 500 companies, the top 10 companies hold the cash. We have 2.4 trillion in cash in the S&P index. The top 10 companies hold more cash than the bottom 400 combined. So this is haves and have-nots that makes the consumer haves and have-nots differential look tame. So I think the ability for companies, even in that investment grade swath, half of which is sort of masquerading as investment grade, but it's really junk, is their ability to handle any increase in debt service is much lower than popularly perceived, because people look at 2.4 trillion in S&P cash and say, look, they're awash in cash on their balance sheets. So anyway, that would be my number one concern. And then I'd come back to China and the idea that their credit bubble will continue to deflate, and that will reverberate, to what degree we'll find out, through the entire global credit system. It remains to be seen just how ugly things get. So far they've managed it okay, but I think there's a lot more to come on that front. And then finally, oil prices. I would echo Lynn's comments about the supply, and obviously, whatever you think about pursuing a green agenda, what it's not doing is helping out prices at the pump. And I think that situation is obviously just going to get worse from the supply standpoint that Lynn was talking about. And then, of course, these geopolitical conflagrations don't help matters. And I think I would suggest that what we've seen with Russia and the Ukraine is just the start of an escalation of geopolitical tensions, whether it's, China to Taiwan or Iran, or, you see emboldened bad actors around the globe, which will probably continue to put pressure on commodity markets and also global supply chains.
God, it sounds,
Okay. Yeah, go ahead, Avi.
I was going to say, it sounds really bad. Is there anything that we could find that's somewhat optimistic? But
Well, this is where I'm going, and Avi, I want to pick up kind of on the theme of something you and I talked about in our last interview together, when we talked about kind of the fact that many more people were being pushed into the rental market, and rents were going up so tremendously. And I was sort of asking you, is there a social concern to this? That we're basically pushing people out of the contention for being homeowners and condemning them potentially to being, renters, where they're increasingly renting from perhaps institutional landlords, and they have very little, ability to react when rents are raised, except just having to pay them. But I want to ask that question on a larger swath here. So, Stephany, you mentioned that household net worth had jumped dramatically, following the pandemic, as all the stimulus was pushed out there. But we all know that it was not equal in terms of how household net worth jumped. It jumped tremendously in the 0.1%. And as you just mentioned, it did jump in the lower household cohorts, but it drained out of them very quickly, right? And we're now seeing record amounts of credit card debt racking back up here. So we've got this accelerating wealth inequality that's continuing to accelerate right now. We've also, because of the Fed's policies in bringing interest rates to rock bottom levels, punishing savers, et cetera, we've pushed people further and further out on the risk curve, right? So they're now all dangling out on the most dangerous end of the risk curve, just striving for some sort of yield or appreciation. Now we're all worried about a pretty substantial market correction, right? So we might basically just pull out the rug from those people while they're out there on the dangerous end part of the risk curve. That's going to create a lot of destruction of household worth for the households that are wealthy enough to own financial assets. As you also said, that could trigger, an economic recession, which then leads to job loss. So, here we've got people that are basically losing the wealth distribution game. They're going to get dinged on the, they're going to be collateral damage in a market correction. They may actually lose their jobs. Meanwhile, inflation, is still raging. We talked about the fact that pensions might, start struggling, so taxes might go up. I mean, this is a really bad list for the average household. Maybe Lynn, Danielle, I'll start with you, and then I'll go to you, Lynn, and we'll catch everybody. But my big question here is, like, are we kind of at a Wile E. Coyote moment for the average household, where we've had this kind of relative tranquility of the past 20 years? Yeah, it was punctuated by the global financial crisis, but beyond that, it's kind of been this relatively tranquil era of prosperity in America and in many other developed nations. And I think we might argue that one of the reasons for that is because we were pulling a lot of tomorrow's prosperity into today. But are we at that inflection point where the chickens start coming home to roost, the piper has to be paid, whatever analogy we want to come up with here? But may we be staring at a decade of substantially lower, kind of quality of living for the average American household? Danielle, I'll start with you.
So, Adam, I think that the risk is definitely there. I wish it was not the case. Part of the driver here is
This excellent roundtable continues over in part 2, where each of these experts shares their thoughts on which assets will fare best and worst over the coming year. Part 2 will be released tomorrow as soon as we're through editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. Be sure to click the like button too while you're at it. And last, if this discussion about the growing instability of our economic, financial, and social systems has you feeling a little vulnerable, then consider scheduling a free, no-strings-attached portfolio review by a financial advisor who can help manage your portfolio, keeping in mind the risks and opportunities our roundtable experts have highlighted here. Just go to Wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of this macro roundtable.
you.